Every once in a while, a small company in a forgotten corner of the market does something special. Now, in a year where healthcare stocks have been left behind and everybody's chasing AI like it's the new gold rush, one biotech quietly beat Big Pharma in court, won a 10-year patent extension, and built itself a cash flow edge until 2035. Now that company is Catalyst Pharmaceuticals. It goes by the ticker CPRX, and it's one of those rare names that's not burning money. It's actually making it. Now the question now is, did this underdog just become one of the smartest defensive plays in healthcare? Is it still under the radar? Is Wall Street paying enough attention to it? And could this be a rare gem that everyone is missing? Alright, so here's what we're getting into today. We're going to start with a quick look at how the healthcare and the biotech sector has been moving this year just to set the scene. Then we're going to get into the story of Catalyst, how this little company built an edge that most small biotechs can only dream of. Then we're going to walk through the numbers, what analysts think, what the big funds are saying, and we're going to check out the charts and the key price zones. And we're going to wrap it all up with what's coming next, the catalysts, the risks, and what could shape the next big move. So, to understand why Catalyst matters right now, you have to see the bigger picture. So, healthcare has long been the market's safe haven. Steady, defensive, resilient. But in 2025, that story cracked. Healthcare stocks have been flat while the broader market ripped higher. Now the sector's forward PE ratio slid down towards 16 times versus about 22 times for the broader market, one of the widest discounts in decades. Now why? Because investors hate uncertainty, and healthcare has had plenty. One is Washington pressure. The first ever Medicare drug price negotiations reshaped the conversation on pricing power. Next, insurers stumbled. Spikes in medical costs and leadership turbulence shook confidence. And third one is patents. Even giants like Pfizer face looming expirations on key patents. So while Big Pharma defends its cash cows and insurers scramble, smaller, focused operators with clean balance sheets are quietly stepping onto center stage. That's the context Catalyst steps into. A sector under pressure, valuations depressed, an opportunity hidden in plain sight. But here's where it gets interesting. Under the hood, biotech has been rebounding from a brutal 2022 and 2023. But risk appetite is coming back, mergers and acquisitions are alive, and investors are finally looking for profitable outliers. That is the lane where Catalyst lives in. So Catalyst isn't your typical biotech go-to-the-moon kind of play. It's got no billion-dollar trial burn, no maybe in 5 years science project. They actually own a niche, and they defend it like their life depends on it. Because right now, their life kinda does depend on it. Now their core drug, Firdapse, treats an autoimmune disorder that weakens muscles. It's a condition that's actually so rare that only a few thousand people have it in the United States. Now it's life-changing for patients, and crucially, it is the only FDA-approved therapy for that condition. Now that kind of exclusivity made Firdapse the company's main moneymaker, and naturally, that kind of success attracted attention. So by early 2025, the giants of Big Pharma showed up to the party like uninvited guests trying to copy their formula. And if they had succeeded, it could have wiped out a huge chunk of Catalyst's revenue overnight. But Catalyst didn't flinch. It fought back and it won. So in August 2025, the company signed a settlement blocking any US generic Firdapse until February of 2035. So similar deals had already sidelined other challenges. One small case remains, but the big threat is gone. Now that doesn't sound just like a win. It is a fortress. And in a market full of uncertainty, certainty is currency. So Catalyst just bought itself time. Time to grow, to diversify, and to do it without dilution. Now let's talk numbers, because this is where Catalyst really separates itself from most of the small biotechs. In Q2 2025, the company posted 146 million USD in revenue, up nearly 20% year over year. And its new launch, Agamree, grew over 200% as it found its footing in the DMD community. Gross margins around 84%. Operating margin close to 50%. And here's the kicker, no long-term debt and over 650 million USD in cash. So while hundreds of biotechs are still burning through investor cash, Catalyst is the rare cash generator. That means self-funded growth, marketing, international expansion, licensing, all without tapping onto investors' shoulders. It's the kind of P&L profile investors love in a messy sector. High margin, no debt, and a clear runaway. And here's the twist. Despite these results, the stock hasn't run away yet. So while the broader biotech index has pushed higher this year, Catalyst only gained a few percentage points over the last 12 months. Why? Well, the market still tags it as a one-drug story. So Wall Street's basically saying, yeah, great numbers, but call us when you invent a second miracle. However, maybe the market hasn't fully priced in yet the 2035 edge, the cash build, or the trajectory of its latest product. Now that kind of gap, strong fundamentals, and a cautious sentiment is often where opportunity lives in the stock market. Now Wall Street isn't blind to it though. Analysts called it a strong buy, which on Wall Street basically means that they actually read the report. Now the analyst consensus for a 12-month target sits at $33. That's roughly 60% upside from where we sit at today at $21 a share. Now institutional ownership is about 80%, showing that big funds already see this as a quality small cap biotech. And what about valuation? Well, it's 12 times forward earnings, which is about half the biotech industry average. So in short, Catalyst is profitable, protected, and undervalued for the quality of its earnings and its cash flows. That is a rare trio in this sector. Alright, let's look at the charts now. On the weekly time frame, Catalyst has been quietly trending higher since 2022, a staircase of higher highs and higher lows. Now on the daily, it's been coiling between 1950 support and 2350, a classic volatility squeeze as price accumulates for its next major directional move. And with earnings on November 5th, that move could be coming soon. Now the 200-day moving average sits just below the current price area, acting as the long-term floor. Now of course, this isn't a meme stock though, so don't expect instant fireworks. This is going to be more like watching paint dry, but you know that the second you look away, it's probably going to break out. Now the stock's been flat this year. It's been moving sideways since August, last earnings call. Now there have been small waves of buying on rising volume, little bit of subtle accumulation which hints that something could be brewing beneath the surface. So what are the key levels to watch? Well, most importantly, the currently outlined key support level at $19, which has held the market over the last 3 months. Now, if we do get a break below $19, most likely we're looking at the next long-term support level at $15.50, where we also find the 200 weekly moving average. It's a level where long-term investors are likely to have their eyes on it to start building up positions if we do get a dip that low. Now, on the resistance side, most important is the current key resistance at $22, which has been containing the sideways action for the last couple of months. A clean break above this level flips momentum to bullish on the daily time frame and aligns it with the long-term uptrend. So that is the goal level. And most importantly, the all-time high at 2650, 20% above the 22 level, and it's the next real test if momentum does build up. Now this isn't about predicting direction, it's about knowing your map before the volatility kicks in. So the next earning report drops on November 5th, which means traders have just enough time to overthink about it twice. So analysts expect about 130 to 135 million USD in revenue and about 50 cents EPS. But the real tell will be in management's tone. Will they hint towards new acquisitions, international launches, updates on the latest remaining generic cases? Because that's what the market wants to hear. Proof that Catalyst can evolve from a one-drug success story into a multi-asset platform. Now, of course, no story is perfect. Catalyst still depends heavily on FIRDAPS, that's both its strength and its weakness. Now, pipeline depth is limited, so growth relies on smart acquisitions, and being a small cap biotech means volatility. Stocks like this can swing 5 to 10% on political headlines alone. But compared to most of its peers, it's a fortress. Cash-rich, debt-free, and now legally protected for a decade. So what makes Catalyst so interesting in the bigger picture? Well, because it represents the other side of biotech, the operational excellence side. So while the world obsesses over billion-dollar obesity drugs and gene editing moonshots, Catalyst shows that focus, discipline, and strong IP can be just as powerful. So it's not flashy, it's not trendy, but it's the kind of stock that quietly pays the bills while everyone else is chasing the next shiny thing. So in a world obsessed with moonshots, Catalyst is that friend who actually shows up on time and does the work. Now, in a healthcare sector still fighting for direction, Catalyst is one of the few that already has one, a clear path of predictable earnings and potential upside. Now, if the sector begins to rotate higher, Catalyst sits right in the sweet spot, profitable, protected, and ready to grow. Now, the whole story pivots on earnings on November 5th after the market closes. And that key level we mentioned earlier, $22 resistance. We break above and hold above that level, and the market might finally start paying attention to this small biotech. So, what do you think? Will Catalyst finally catch up to the biotech rally, or will traders fade the next earnings report? Let me know in the comments, and I will catch you in the next video.